Some way to determine whether transaction is a business or not. Acquire the input and process. No, go to A. That go to A and B. Yes, the output exists in acquired date. Yes, the ability to criticize, the ability to continue production and output and input acquired, including organization, product experience, workforce to perform the process. Whether the acquired processes are unique, as scarce or no, cannot be replaced without a significant cost, effort, and delay. No, we'll go to A. And whether critical, go to A. What is A? So no substantial process acquired. It is an asset acquired. In the case where the input acquired both as organized workforce and perform the process and including other input and workforce would develop into outputs. Then, if known as substantial process is required, it is a business combination. Okay. Simple process combination. A company acts as a liquor company has a traded number of years, and company products produces a wide variety of liquors and employs a workforce and machine operators, testers, and other operational, marketing, administrative phase stage. It also operate a factory, warehouse, and machines and hold raw material and inventory finished good. Finished good. 1st October of the year, company pays 80 million to acquire 100% of the ordinary voting shares of the company. No other types of shares has been issued by the company. On the same day, the four main executive director of the company white takes the same roles of the company. In the case of clear of the company act of the business, which operate trade with the variety of assets used to employ a number of related activities. These assets of activity necessary integrated in order to create and sell the company's product. As a definition, above acquisition, including input, includes four main executive director companies. That is a conclusion that significant process acquired along with the other inputs. The company obtained the control of January and acquired 100% of voting rights. This application definition is less clear. Its significant illustrations for example. The investment is a developing stage entity. The company D is a developing entity, development stage entity that has not started revenue generation operation. The workforce consists of mainly research engineers who is developing new technology that is pending patent application. Negotiation to license this technology to the number of customers are in the advanced stage. Company D requires additional funding to complete the development of work and commercial plant and commercial production. Value of the identifiable net asset is 750 million. Company D and Company A pays 600 million to exchange of 60% of the equity of Company D controlling interest. Although company D is not yet earning revenue, example of output there is then the number of indicates that is a significant indicates that activities and assets that are capable of being managed to produce a return on investment. The particular company D employs specialized engineers and develop the know-how and have designed and significant of the technology in pursuance of a viable plan to complete the development work and commerce production. It is identified and it will be able to access customers willing to buy output. Additional Company D has paid premium on goodwill of 60% interest in the absence of the evidence of the contrary. Company Ds are presumed to be business. Example for acquisition of the entity's holding investment property. In the company D acquire 100% of the equity of voting rights of the company P and subsidiary of the property investment group. Company P's own three investment properties. The properties are single tenant industry warehouse subject to long-term leases. Lease is obliging company P to provide basic maintenance and security service which has been outsourced to third party contract. The administration of the company P leases and carry out by an employee of its former partner company on a part-time basis, but the individual does not transfer the new owner. In the most cases, the assets of the group of assets or liability that are being capable of generating revenue combined with all or many of the activities necessary to earn this revenue would be constitute a business. However, the investment property is a specific case in which earnings and return of investment is defined characteristics of the asset. According to revenue generation activity, specific and auxiliary to investment property and tenancy agreement, should there be given a lower weighting in assessing whether the acquirer is a business. Further process of basic maintenance and security service and administration is not crucial to ability to continue production output. As process basic maintenance, security service and administration is not unique and it can be replaced easily without significant cost. In the view of the purchase of the investment property, the tenant and service that is purely auxiliary of the property and the tenancy agreement should be generally be accounted for the asset purchase. Acquisition of the entity holding an investment property. A company A acquires 100% of the equity and voting rights of the company Q, which owns three investment properties are multilateral residential condominium subject to short-term rental agreement to obligate company Q to provide substantial maintenance and security service, which is outsourcing specialized providers. Company Q has a 5 employees who deal directly with the tenant and with the outsourcing contractor to resolve any non-routine security or maintenance requirement. These employees are involved in a variety of less management tasks like address identification, selection of tenants, lease negotiation, and rent review, and market activities maximize the quantity of tenants and rental income. In this case, a company Q consists of a group of revenue generating assets and together with the employees and activities that clearly go beyond the activities and accelerate to the property and the tenancy agreement. The further process identify and selection of the tenant, lease negotiation, and rent review, the producer the ability to continue production output. That is the terms to maximize the quantity of the tenants and rental agreement. Assets and activities are clearly integrated to company Q considers as business. Examples is seller, renter, later rent in some activities and such. Company as a manufacturer a wide range of product companies payroll and accounting system is managed and separate cost center and supporting all the operating system. Company agrees to acquire the trade assets and liability and workforce of the operating requirements of companies but does not acquire the payroll accounting cost center as the head office of companies competitor of companies. In this case, activity and assets within the operating segment is capable of being managed as a business and the company is accountant for the acquisition use a digital combination. The payroll accounting cost center administration head office are typically not used in creating output and used as a generally not considered as essential element in assessing where the integrated set of activities assets are in the business or not. The acquisition of cell company is a property developed company which is number of subsidiary company which holds a single development. After completion of the development, company A sells its entity investment because applicable tax rate is lower than the applicable sale of the underlying property. Company A is planning to start a development and large new retail complex. Other than incorporating a new company, company acquires the entire share capital of a shell company. Shell company does not contain integral set of activities and assets and so does not constitute a business. Subsequently, company should account the purchase of the shell company in the same way the incorporation of new subsidiaries. It is consolidated financial statement as a cost incurred in the contract of the account of the accordance with the nature and applicable NDAs. No goodwill is recognized. Company B is a pharmaceutical company. Since the incidence of company has concluded in-house research and development activities through skilled work was recently obtained intellectual property rights. It forms a patent over certain products. Company has production plan has recently obtained regulatory approval as company has not earned any revenue so far and does not have any customer contract or sale of the goods. And company B acquires company A determined the company A consider business according to the NDAs 103. Definition of business requires existence and input and resources. In this case, the skilled workforce, manufacture, plant, and IPE are along with strategies and operating process constituting input and process in the lineup. Requirement of India is 103. In this input and process applied to the integral set of company A will be capable of producing output. The fact that company A consists does not have any revenue not relevant to the analysis of definition business. Under India is 103 based on the enterprise assumption a company A would have been able to obtain access to customer that will purchase the output and present case as said constitute the business. As per India is 103. Modifying the above illustration, company as a revenue contractor than sales force, which company we acquires and input and process the other than the sales force, then would definition of the business is made in accordance with India's 103. Though the sales force has not been taken over, however, the missing input the sales force is easily replicated operating by the market participant and generate output. It can be concluded that company A has acquired business. Further, company B is also a similar line of business when the existing sales force of the company B may also be relevant to mitigate the missing input. As a research, the definition of business made according to section India's 103. Acquisition method. The following key steps are involved in acquiring a business account or business combination: identifying the acquirer, determining the acquisition date, recognize and measure the identifying asset acquired and liability assumed by non-controlling interest of acquirer, recognize, measure goodwill and gain from the bargain purchased. As the following questions of account of business combination transaction: who is acquired, when the business is acquired, and which assets are acquired and liabilities are assumed, and what value based assets and liability when IC is acquired. Check for any goodwill gain or bargain purchase. Identifying acquisition enterprises. All the business combination, the scope of India is 103 is account and under the acquisition method. That is because of purchase method. In order to apply the purchase method, the parties involved identify the acquirer, that is Entity that obtain control over another entity, the entity on whom the control is established terms as acquiree. This is because acquiree assets and liabilities are accounted as per the recognition measurement of principal standard. The acquiring enterprise is the enterprise that obtain control and determination of control as per the guidance and NDA 110. As may be happened, guidance of NDA 110 does not clearly indicate that the accompanying entity is an acquirer. In this case, NDA 103 provides additional guidance for identifying acquirer. NDAs 1 and 10, a consolidated balance statement, investor control and investee if and only if the investor has following power over the investee, exposure, right to variable return from the involvement of the investee, ability to use his power over investee and affect the amount of the investor's return. The above definitions of wide and control guide and control assessment does not depend upon the voting rights, instead depending upon the following as well: potential voting right and non-control on shareholder, other contribution rights and investor if there is a substantial nature. Control assessment over this discussion is detailed in chapter consolidation statement. One example of potential voting right and implication of assessment of control is provided below. The students understand the concept of control. The art associate the control, do not look over the voting rights only, evaluate the control like board control, potential voting right, etc. Indicator control: more than 50% of voting right power to appoint and remove the board of director. Investor has currently exercising potential voting rights. Illustration: potential voting right. The company B is a manufacturer right taxable products, acquire 40,000 equity share of the company X and manufacture complementary products. Out of the 1 lakh shares of issues, apart from the same agreement, company P has an option to acquire additional 40,000 shares. The option is accessible at the time the next 12 months. The option exercise price includes small premium to be the market price of the transaction date. After the above transaction, shareholder reacts to other original shareholder or 30,000, 20,000. Each of the shareholders has currently exercising option to acquire an additional 2,000 additional shares. Assessee who controls the acquire of the company B. Assessee whether the obtaining control over X company B should consider not only the share of 40,000 it was, but also option to acquire another 20,000. So it's called potential voting right. In assessment, the specific terms and conditions, the option agreement and other factors considered as follows. The options are currently exercisable and there are 2 other required conditions before such options exist. If exercised, then the options must be increased company B ownership and controlling the interest of 50% more of the considering about shareholder potential voting right 65% shares out of 1,20,000 shares. Although other shareholders have potential voting right, it is all the options are exercised and company B share own majority of 65,000 out of 1,28,000 shares. The premium including excise price make the option out of the money. However, the fact of the premium is small and option has confirmed majority ownership indicates that the potential voting rights of the economic substance. By considering all the above factor, company B concludes that the acquiring of the 40,000 shares together the potential voting right, it is an obtained share control of the company. Acquisition through payment of cash and incurring liability. It is a company's combination effect primarily by transferring cash and other asset by incurring liability, and acquiring is usually entities that transfer the cash and other asset incurring liability. Acquisition through the issue of equity treatment in the business combination effect primarily by exchanging equity interest. Acquirer is usually the entity that issues its equity interest. However, in some business combination commonly called revenue acquisition, it is issuing equity to the acquirer. Reverse acquisition has been dealt in separate sections in chapter 1. Patent factor circumstances shall also be considered identifying the acquirer in a business combination affected by the exchanging equity interest, include relative voting rights and combination entity. About the business combination, the acquirer is usually the combination entity. The owners of group retained receive the largest portion of voting right in the combined entity. Determining which groups of owners retain receive the largest portion of voting right, entity shall consider the existing of a usual and a special voting arrangement option, warranty and convertible equity. Illustration 5. Veera Limited and Zira Limited are both the business of manufacturing and selling lubricants. The shareholder of Veera Limited and Zira Limited agreed to join forces to benefit from the lower delivery and distribution costs. This business combination was carried out to setting up a new entity. Veera Limited issues 100 shares to Veera Limited shareholder and 50 shares to Zira Limited shareholder, exchange of the transfer of shares to the entity. Number of shares reflected in the reflecting reduced fair value of the entities before combination. Also, respective company shareholder get the voting rights of Veera Limited based on the respective shareholder determined determine the acquiring of applying principle of Ind AS 103 business combination. As per the B5 assessment, Ind AS 103, the business combination affect primarily for exchanging equity interest. Acquires usually entity that is issue the equity interest. However, some business combination commonly called reverse acquisition. The issuing entity of the acquisition, other pertaining fact comments shall also consider in identifying the acquirer in the business combination effect by exchanging equity interest accordingly. Relative voting right is a combination entity after the business combination. The acquirer is usually the combination entity where the owner as a group of receive the largest portion of voting rights in the combined entity. Based upon the mentioned para, acquirer shall be the entity of combining entity, that is Vera Limited and Zira Limited, whose owner of group receives the largest portion of the voting rights in combined entity. Hence, the scenario Vera Limited, the shareholder, gets 67% of shares at 100 out of 50%, and Zero Limited shows 33% of the Vera Limited. Hence, Vera Limited acquire is a principle of Ind AS 103. Existing larger minority voting interest as a combined entity. If no such owner organized groups of owner significant voting interest, acquire is usually the combined entity whose single owner is organized group of owner holds the largest majority voting interest in the combined entity. The composition of governing body and combined entity. Acquire is usually combined entity whose owner has an ability to elect and appoint a majority of members in the governing body in the combined entity. Composition of senior management of combined entity. The acquirer is usually the combined entity where the former manager dominates the management combined entity. In terms of exchange of equity interest, the acquirer is usually combining entity that pays a premium over pre-combination fair value of equity interest of the other combination entities and entities. The acquirer is usually combined entity. This size relative measured in form of assets, revenues, and profit significant greater than one of the other combining entities in the business combination involves more than two entities. Determining acquirer shall include consideration of among other things such as combination entities initiated at the combustion as well as relative size of combination entities. Example: Company A and Company B operate in power industries. Both entities operate entity. Company has a larger scale of operation than Company B. Company B merges with Company A, such as shareholder of Company B who receive one equity share for Company A for every share held in Company B. Thus, issues and shares would be compressed 20% of the equity share capital of Company entity. After discharge of the purchase and the pre-merger agreement of Company A holds 80% of the capital in Company A. In the transaction, Company A is acquiring for purpose of accounting of the business combination as per Ind AS 103. It is because a merger of entire shareholding Company B. Company A is acquired to control over Company B for the shareholder arrest while Company B do not obtain control over Company A on the accounts of share received as part of the purchase consideration. It's more than 20% of the paid up capital of the Company B. Company A and Company B operate the power industry. Both entities are operating entities. Company A is much smaller scale of operation. Company B. The Company B merges Company A with the shareholder Company B, which receive 10% equity of the Company A with every one shareholding Company B. Thus, the issue of share was compressed 70% ratio, and the share capital combined entity after discharge of the purchase consideration pre-merger shareholder Company A hold 30% capital of Company A. And a pre-acquisition management management of Company B would manage the operation of combined entity. Whereas a Company B is acquired for the purchase of accounting of the business combination in the Ind AS 103. This is because after merger shareholder has to the Company B would have controlling interest in the management of combining entity. Thus, the options of Company B is acquired over Company A. It is important to note that Company B would be considered as acquirer of the accounting purposes only. Accounting acquirer for legal purpose as well as a reporting purpose. Company A would have been considered as acquirer, that is a legal acquirer. Appropriate identification acquirer is relevant and net asset of the accounting acquirer rather than the accounting acquirer as a case for the fair value. ABC is incorporated company Super Limited acquired 100% shares of another company equity Focus Limited. Therefore, obtain the control of Focus Limited to fund the purchase. Super Limited acquired the loan of XYZ Bank to commercial interest rate. The loan funds are used to Super Limited to acquire the entire voting share of Focus Limited to fair value of ordinary transaction. Post acquisition, Super Limited has an ability to elect, appoint, and remove the majority of share members of the governing body of the Focus Limited, and also Super Limited is a power were able to dominate the management Focus Limited. State whether Super Limited is identified as acquirer of the business combination. Para 6 Ind AS 103 states that each of the business combination. One of the combination entities shall identify as acquirer, while the para 7 state that the occurrence of NDAs 1 and 10 shall be used to identify the acquirer where the entity is obtained control of the other entity called the acquirer. The business combination occurred by applying the guidance of 1 and 10 does not clearly indicate the combination entity of the acquirer. The fact of paragraph para 14 to para 18 of NDAs 1 and 3 to consider the making is determined for para B15 say the business combination effort primarily for exchanging equity interest. Acquirers generally usually the entity that is interest applies issue the equity interest. However, some of the business combination commonly called reverse acquisition is issued entities in this acquiring. Other pertinent fact and circumstances shall also be considered identifying the acquirer in the business combined affected by the exchanging equity interest including relative voting rights in combined entity after the business combination. The acquirer is usually combined entity. Those owners or the group retain and receive the largest portion of voting rights and combined entity. Determine the groups of owner rating to receive largest portion of voting rights. The entity shall consider a traceable unusual special voting arrangement often warrant and political security. The existence of a large minority vote. Existence of large minority vote issues in the combination entities. Owners include the owners a significant voting interest. Acquirers usually combine an entity where a single owner is often or organized group of owners hold the largest majority voting interest in the combined entity. The composition of the governing body of the combined entity. Acquirers usually combination entity where the owner has the ability to elect, appoint, or remove the majority members of the governing body of combined entity. Composition of senior management combined entity. The acquirer is usually combined entity whose management dominates the management of combined entity. In terms of the exchange of equity interest, acquirer is usually combined entity that pays a premium over pre-combination of fair value of equity interest on other combination entities. Key drivers of accounting are identify the parties on behalf of the new entities has been forced to identify the business acquisition in the scenario. Super Limited has able to elect and appoint remove majority of member of the governing body for the Focus Limited and ability to dominate the management of Focus Limited. According to Super Limited, will be identified as acquirer unless the condition of the concluded monopoly. Acquisition involves shell company and reverse acquisition. Reverse acquisition occurs when the entity has issued securities and identified the acquirer for accounting purpose. The entity whose equity interest acquired and has been acquired for accounting purpose of the transaction to consider as reverse acquisition. For example, reverse acquisition sometimes occurs when the private operation entity wants to become public entity but does not want to be registered equity shares. To accomplish the private entity will arrange the public entity to acquire equity interest in exchange of the equity interest of the public entity. For example, the public entity is a legal acquirer because it's issued the equity interest, and private entity is a legal acquirer because of the equity interest and acquire. However, an application of the guidance as above paragraphs is a result of identifying public entities an acquiree, another public account and accounting acquiree. Private equity acquirer is the following purpose and accounting acquiree. Accounting acquiree must be made the definition of business of transaction to the account of the reverse acquisition. All the reconciliation and measure of NDAs 103, including the requirement of recognizing goodwill by applied. Reverse acquisition. The balance sheet of ATA immediately before the business acquisition as follows. Current asset 600, 800, non-current asset 1200, 200. Total asset and liability 400, 200, non-current liability 300,000, 200. Total liability. Equity is 30% share 360 out of 10. 600 retained earning 800,000 total equity. Total equity and liability. On the 31st March, EA shows 2.5 share exchange of the each shares of company B. All the entity shareholder exchange what the shares are therefore the equity issues 1,50,000 shares exchange of 60,000 shares in the company B and A is legally own 100% of the B. The shareholder of equity B hold 83.3% of combined entity. These and the director of company B is appointed 6 of 8 combined entity for the according to the one the IND is 1 and 3. Entity B is a legal acquirer of the accounting acquirer. Entity A legal acquirer is an accounting acquirer as entity B shareholder control over the company entity. Quoted market price of the company. Market price of the company entity B shares is 31st March is 105 per share equity. Equity A share price of 31st March is 20 per share. Okay, assuming that the fair value of equity is identified at asset and has the same carrying value in no tax rate. The acquired date of 31st March, the accounting acquired equity instrument generally used to determine the amount of consideration transfer for the business combination. In this case, is 105 per share equity. If the business combination taken place and issuing additional shares of equity B, shareholder exchange of this shares of equity A, and the equity B should have issued 12,000 shares. That is 30,000 divided by 5. And the ratio of the ownership instead of combining entity is 12,000 to 7,200. Therefore, the considering the business combination effect of the entity 12 lakh 60,000 shares, 12 lakh 60,000. Calculation of goodwill, the fair value of asset less liability 1 lakhs, consideration transferred for entity, so goodwill is 1 lakh 60,000. New parents A pays cash to follow effect the business combination. Company A decides to spin off two of the existing business currently hold two separate entities, business B, company B and company C. The facilitating spin off company incorporate a new company, company D, and a normal equity and appoints independent director to the board of company D. Company D signs agreement to purchase company B and C in the cash. The condition to obtain sufficient fund to fund this acquiring company D issues a prospective offering to issuing share of cash. At the conclusion of the transaction, company D is owned 99% of the new investor with the company A retaining only 1% of the non-controlling interest. In the situation set of a new investor paid cash to obtain control D and the arm's transaction, company D is used to affect the acquiring of the D ownership of the company B and Z by paying cash. Company is relinquished to control company B and company C and the new one company D. Although company D is a newly formed entity, company D is identified as acquirer not only by paying cash but also provide new owners of the company D have obtained control of company B and company C's control the control only identifying the acquiring enterprise very critical and accounting may choose significantly accounting acquirer and a different legal acquirer. Determination acquisition. The acquirer shall identify the acquiring date, which is the date of obtaining control of acquiring. Date of the acquiring obtain the control of acquiring is generally date at which the acquiring legally transfer the consideration. Acquiring the assets and assuming the liability of acquisition, the closing date, however, the acquiring might obtain control of the date and which earlier on the later on the closing date. For example, acquisition date preceding the closing date, the written agreement provides that acquiring obtain the controls of acquiring on a date before the closing date, and the acquirer shall consider all the pertinent fact of presenting circumstances identifying the acquiring date. Acquisition date is a very important step in the business combination accounting because determining and acquiring, recognition, and measuring of consideration asset acquired and liability assumed the acquiring result of consultation from this date. From this date, acquisition date materially impact the overall acquisition accounting, including post-combination earning. Acquisition date will be date on which acquires obtains control. The acquisition date is often readily apparent for the structure of the business combination terms of sale or purchase agreement and but this is one not all- not one this is not always be taken care of. Company to A acquires 80% of the equity interest of company B in cash consideration. Relevant dates are date of shareholder agreement 1st June, appointment of date of shareholder agreement 1st April, and the date of obtaining control over the board is 1st July. Date of payment of consideration 15th July. Date of transfer of share to company A is 1st August 15th. In the case of control of the financial operating policies acquired through obtaining the board resolution of 1st July. Date is considered as acquiring date as the note that appointment date as that agreement is not considered as an acquiring date. Company has not they have control over the country and the state date. Okay, and the acquiring entity account for business combination based on a signed non-binding letter of intent where the exchange of consideration and the other conditions are expected to complete in 2 months. No, it's a requirement of a standard non-binding letter of intent. LOI does not affect the transfer of control. Hence, this cannot be considered as a base of determination of acquiring deed. The 1st April agrees to acquire the share of B Limited in any equity deed. As per the binding agreement, it does affect the control of 1st April. However, the consideration will be paid only a shareholder approval. The shareholder means unscheduled happens 30th April. Shareholder approval has not received in the few issue of the new shares and consideration settled in case determining acquisition date is 1st April because of few some scenario even shareholder don't approve the shares and considered shall be settled through the payment of cash. Business combination without court approval scheme. ABC is acquiring all the shares of XYZ Limited, negotiating the commencement of the first January, and the agreement was finalized in first of March. And the ABC obtains the power of control the operation first March. The agreement states that the acquiring effective first January, and the ABC will entitle all the profit after the date. In addition to the purchase price is based on explicit net asset position and the first January determine the date of acquisition. Paragraph and D is provided that the acquiring date and date is a date acquiring obtaining control of the query. Further, the paragraph 6 and 7 of India's 110 consolidation financial statements internally states that investor control the investee when the exposed has a right and variable return from the involvement of the investee and has the ability to affect those return through the power over investee. Thus, the investor controls the investee. If it's only the investor has a following power over the investee, expose the right and variable return on the investment of the with the investees and ability to use the power over investee to affect the amount of investor return. For the purpose of paragraph 9 of India is 103 clarifies that the date of the acquirer obtains control over the acquiring is generally date of the acquirer legally transfer consideration, acquiring the assets and assuming the liability of the acquirer in the closing date. However, the acquirer might obtain control on the date at which either the date or earlier at the later closing date. Therefore, in the case of not present price is based on the net asset or the January, shareholder do not receive the dividend on the after the date of acquisition accounting is first March. It's only first March, not first January. ABC Limited has indirect power to direct relevant activities XYZ Limited. So, they find the return of the investment involvement XYZ Limited according to the date of acquisition first March. Acquiring date of regulatory approval. ABC Limited expedition to manufacture rubber component. A particular date of equipment. ABC Limited makes a bit of expedition limited business and the competition commission of the India announced that the proposed transaction is to be scrutinized to ensure that the competition law was not breached. Even though the contract are made subject to the approval of CBI and ABC Limited and XYZ Limited may mutually agree the terms of acquisition are proposed of the price based on the competition or authorized clearance of it. An acquisition data scan the division of data ABC and XYZ agrees to terms even though the operation of CG is weighted assume the approval of CGI and sensitivity. Paragraph 8 of the India's one of the provides acquisition date and the date of acquiring obtain control of the acquiring. Further, paragraph 9 of India's one of the India's 103 clarify the date of which acquirer obtains the control of acquirer is generally date of which acquirer legally transfer the consideration acquiring assets and assuming the liability of the acquirer. The closing date, however, the acquirer might obtain control of the date in that it is either earlier or later of the closing date. For example, acquisition is the date preceding the closing date. If the written agreement provides that acquirer obtains control of the acquisition on the date before the closing date, acquirer shall consider all the pertaining facts and circumstances and data identifying the acquiring date. Since the CC substantive approval of CBC Limited to occur control of XYZ limit in operation, the date of acquisition cannot be earlier than the date of approval is obtained from CCI. The pertainment given to the approval of CCI is considered as a substantial process. Accordingly, acquisition is generally considered to be complete only on the receipt of such approval. Step acquisition. In the case of entity acquire an entity step by step through a series of purchase and acquisition date in which date of which acquired obtain control. Till the date of control is obtained, investment will be account as per the requirement of India's 109. If the investment is covered under the standard as per India's 28, investment of associates or joint ventures. Associates or joint venture. If the company combines achieves the stages, the acquirer shall remeasure the previous held entity interest, equity interest in the acquirer as the acquisition date, fair value and recognize the resulting gain or loss if any of the profit or loss of the comprehensive incomes are appropriate. In the prior reporting period, the acquiring may have recognized changes the value of equity interest in acquiring as the comprehensive income. If so, the amount that is recognized as a comprehensive income shall be recognized as the same basis of the acquiring but as disposal of first directly the previously held equity interest. Below are the example of acquiring business in the case of stake acquiring CS. Fruit Limited acquired 15% stake in Mango 1st April. Fruit acquired Limited acquired 20% stake in Mango 50 April. Fruit acquired Limited 60% in Mango on 31st March. The acquire of 31st March and example total stake as the date of 90% as in control is Control is assumed in the total stake and unless otherwise stated. Determination of purchase consideration. Consideration stands for the business combination shall be measured in fair value, which is calculated on the total on acquisition date. A fair value of including cash transferred by the acquirer, the liability incurred by the acquirer to form owners of the acquiry, and the equity interest issued by the acquirer. For example, the form of consideration including cash and other assets. A business or subsidiary of acquiring contingent operation and ordinary preferential equity option and reward members interest in mutual entities. Exemption for fair value determining purchase consideration. However, any portion of the acquirer's share-based payments award exchange for the awards held to the acquiring employing as include consideration transfer and business combination shall be measured in accordance with the requirement of Ind AS 1 or 2 share-based payment. Consideration transfer may include assets and liability of acquirer that they have carrying amount and differ from the face value of acquirer date. For example, non-monetary assets and business of acquirer. So, if so, the acquirer shall remeasure the transferred asset and liabilities with the fair value of the acquisition date and recognize the result gaining and losses, if any, of the statement of profit and loss. This means the acquirer has to transfer the land as part of the business combination arrangement to the owners of the acquiry, and the fair value of land will be considered as a determining the fair value consideration. Consequently, land will be de-recognized in the financial statement of the acquirer, and the difference between the carrying amount of the land and the fair value considered the purchase consideration will be recorded as profit or loss. However, sometimes the transfer asset and liability remains within the combined entity after the business combination. For example, assets and liability are transferred to the acquirer rather than its former owners, and the acquirer therefore retains control for them. In the situation, the acquirer shall measure these asset and liability as a carrying amount immediately before the acquiring date and shall not recognize a gain and loss in a statement of profit and loss account, and assets and liability is controlled before both and after the business combination. Although no gains and losses recognized a transfer entity, the assets and liability transfer will affect the amount of NCI and goodwill to be recognized. Purchase considerations and record summarize. The fair value of assets transferred including cash liability incurred by the acquirer, former owner acquiring, purchase consideration, contingent consideration, and equity interest issued by the acquirer. Business combination achieved in stages of acquisition. The acquirer sometimes obtain control of the acquiring in VS held by the equity interest immediately before the acquisition date. Example, 30th December, equity A holds 35% of non-controlled equity interest of equity B, and the date equity A purchases the additional 40% of the equity will be in the Q1 control of it will be. Transactions refer to the business combination achievement stages. Sometimes it refers to step acquisition. The business combination and achieved stages, the acquirer shall reimburse them and previously held equity interest on the acquiring, and the acquiring date, fair value of recognition of resulting gain and loss, if any of the profit occurs. The prior reporting period, the acquirer may have recognized changes in the value of equity interest and acquiring of the comprehensive income as a per. Ind AS 109 and Ind AS 27, equity can elect the measure investment in the equity instrument as the fair value through the comprehensive income. However, once elected, all the gains and losses on the investment one on the sale recognized OCA. Therefore, the investment is designed for the fair value to OCA. A resulting gain or loss, if any, will be recognized in OCA. And the party of the joint operation obtain control for the joint operation business and transaction will be considered as a business combination achieved stages. Acquirer shall remeasure the previously held interest of the joint operation fair value of the acquisition. Illustration 11, on the 1st April, the PQR Limited acquired 30% of the voting rights of the and for 30,000 crores. PQR Limited accounted for investment expenses by using entity method as prescribed under Ind AS 28, 31st March, and PQR Limited recognized the shares of the net asset value, equity merchant value, share of profit and loss 100, share of exchange of OCA 100, share of revaluation reserve PPE 50. The carrying amount of investment therefore is 8,850 crores, that is 8,000 crores plus 500 plus 100 plus 50. On the 1st April of 2002, the PQ was acquired at a remaining 70% worth to 25,000 crores. The following additional information is relevant. Fair value 30%, the interest already owned 9,000 crores. Fair value of identified asset 30,000 crores. Determine the accounting for the business combination. In the paragraph 2 of NDAs 103 provides that a business combination achieves such stages. This acquirer shall remeasure the previously held equity and acquirer at the acquisition date and fair value recognize the resulting gain or loss. If any statement of profit and loss and other comprehensive income and appropriate, the prior reporting period the acquirer may have recognized changes in the value of equity interest and acquirer's other comprehensive income. If so, the amount of the recognized other comprehensive income shall be recognized in the same basis as would be required to be acquired as disposed directly by the previously held equity interest. Applying the above PQR limited records are following entries consolidated financial statement. Identifiable net worth expenditure 30,000, goodwill 4,000, and foreign currency translation reserve 1,000. Um, and PPA limited 50, goodwill 4,000, and into cash 45,000 and 1,000. Investment associated 8,850, retained earning 50, gain in the previously held interest of Ganesh profession 50. Goodwill cash concept 25,000, fair value previously held to 9,000, total 34,000, fair value identified as well 30,000, goodwill 4,000. Credit to remain credit to retain the earnings represent the reversal of the unrealized gain of 50 crores at other comprehensive income related to revaluation of the property, plant and equipment. This include this accordance with the India 16, the amount is not classified in the profit and loss account. The gain is previously held equity equivalent calculated to 30% of the interest is 9,000, the carrying amount of interest is 80 by 0. 150 unrealized profit gain is 100 is 100. The gain of the previously held interest is 250. Business company achieves without the transfer of concentration. The acquisition sometimes accompanies control of the acquisition without the transfer of concentration. The acquisition method accounts for the business combination applies for the combination such as combination includes the acquirer repurchases sufficient number of own shares in existing investor. The acquirer is obtain control. Minority veto shares lapse as the previous capital acquirer for the controlling as acquirer. I mean the acquirer held the majority of voting rights. The acquirer and the acquirer agree to combine the business and contract control. The acquirer transfers no consideration exchange of the control of the acquirer and holds no equity interest in the acquirer. Either acquisition data previously, for example, business combination achieved by contract alone, including presenting two businesses together and stapling arrangement forming a dual listed corporation. The business combination is achieved by contract alone. The acquirer shall attribute the owners of the acquiring the amount of acquiring net asset recognition in the acquiring within the Indian account channel. The other words, equity interest in acquiring held by the parties other than the acquisition, non-controlling interest in acquiring post combination financial statement, even if the result and all the equity interest in the acquiring is attributable to non-controlling interest. Business combination achieved by contract alone. Sita Limited and Beta Limited decided to combine together to form the dual listed combination. As per the shareholder agreement, both the parties should retain original listing and holding of DLC. The company comprises 10 members out of 6 members. The Sita Limited and remaining 4 members by Beta Limited. The fair value of Sita is 100 crores and fair value of Beta is 80 crores. The fair value is net identified assets of Beta Limited is 70 crores. Assuming net controlling interest on a certain fair value, it has a goodwill to recognize in the acquisition. Sita Limited has more board members and however thereby having majority control DLC. However, DLC Sita Limited identifies acquirer and Beta is acquiring. Since no consideration has been transferred, goodwill needed to be calculated as in the difference of A and B. Consideration paid by the acquirer is controlling interest of the acquirer 80 crores, acquiring previous interest in them. Fair value of the interest is 70. Goodwill records 10 crores, a common combination achieved through the contract alone NCA measured in the fair value. Direct control of acquisition. The direct cost of acquisition is not including the determination of the purchase consideration, the cost which includes finding fees, due diligence cost of accounting, legal fees, investment, banker fees, even bonuses paid to the employees doing successful acquisition will not be included in the cost of acquisition. Stamp duty paid by acquisition of the land pursuant to the business combination be capitalized the cost of the asset and whether it is stated acquiring related costs and according to the expenses of. As per the India AS 103, acquisition correlating costs incurred in acquiring the effect of business combination is not part of consideration transfer. Para 53 of India AS 103 stated that acquiring related costs are costs and acquiring incurred to affect the business combination. Those costs include finder's fees, advisory, legal, accounting, valuation, other financial consulting fees, and generally administration costs, including the cost of maintenance and internal acquiring department, cost of registering and issuing debt and equity securities. Acquirer shall account for the acquisition of costs, expenses per year in the costs incurred and the services received upon one exception. The cost is issued on debt and equity security shall be recognized in accordance with the NDA 32 and NDA 109. Stamp duty payable, transfer of asset as a connection with the business combination in the acquisition related cost is covered in the described under the paragraph 53 of NDA 103. Stamp duty is a cost of income by the acquired order to affect the business combination. It is not part of the fair value exchange between the buyer and seller of the business. In the case of stamp duty is incurred and acquired by the ownership right of the land is owner to complete the process of transfer as per the overall business combination transfer, but it does not present the consideration paid to gain control over the business of the seller. It may be noted that the accounting treatment of stamp duty retained the separate acquisition of the item of plant and property equipment is not of business combination different under the NDA's plan 16 plant property equipment unless NDA 16 acquiring accounting as per the NDA's 103 requires others are liability covered in the business combination to measure on the value. This includes the connection of the business combination. Stamp duty does not increase the future economic benefit but needs asset compromise of business. This includes recognition fair value, hence it cannot be applied. The example of cost given para 54 is an inclusive list. They are only indicated does not preclude other costs being considered in acquiring metals. It has been given in case the transfer of land and credit stamp duties required to be accounted as per the compensation treatment as per the acquired 103 and non-separate transaction indices. According to stamp duty incurred relating to the land acquired the part of in combined business transaction acquired to be recognized as expense in the period in which acquisition is complete, given the effective financial statement of the acquirer. ABC did acquire the PQR Limited at 30 June. The asset acquired in PQR Limited, including intangible asset that comprises of wireless spectral assets for the intangible asset. ABC Limited acquired to make an additional one-time payment of regulator PQR jurisdiction to order to right to be transferred to use. And then the additional payment to regulators acquiring acquisition related costs. As per NDAs 103, acquisition related costs incurred by the acquirer to affect the business combination are not part of the consideration transfer. And the paragraph 53 109 states that acquisition related costs that acquire incurred to affect the business combination. These costs including finder's fee, advisory, legal, accounting, valuation, and the professional accounting fees. And the general administration costs including cost of maintenance and income. Internal acquisition department, the cost of the registration, issuing the tips and equity for securities. The acquirer shall account for the acquisition relating costs as expenses in the period which the cost is incurred under service with an exception. The cost issued debt of the equity services shall be recognized in accordance with the NDAs 32 and NDAs 110. Payment to the regulator represent the transaction cost and will be regarded as an acquisition related cost issued to affect the business combination. Applying the requirement of paragraph 53 and NDAs 103 should be expensed as an inquiry. Expenses incurred. The transfer right of the instant case cannot be considered as a separate form of business combination because the transfer of a right to ABC is an internal part of the business combination itself. In this case, note that the right has been acquired separately, that is not the part of business combination. Transaction costs are acquired to be capitalized as part of intangible asset as in requirement NDA 38 intangible assets. Contingent consideration. Contingent is a consideration transfer or exchange of the acquirer, including set of ability to resulting of contingent consideration arrangement. The acquirer shall recognize the contingent date fair value contingent consideration a part of consideration transferred in the exchange of acquiry. The acquirer shall classify the obligation to pay contingent consideration to ability to equity on the basis of definition of the equity instrument of financial liability in accordance with the requirements of NDA 32 financial instrument presentation other applicable Indian account statement. The acquirer shall classify as a asset as a right of return of previously transferred consideration specific condition as a right. The fair value of asset transfer or liability incurred should be measured on the acquisition date. Determine the fair value of the date. The direct cost acquisition should be recorded directly, and profit and loss account should not be included in the purchase consideration. For example, company A acquires company B in April for cash. The agreement state that the conditional 20 million cash will be paid by B for former shareholder. B succeeds in achieving certain specific performance targets. A determines the fair value of contingent consideration liability 15 million acquitted. Later date, the probability of meeting the same performance target become lower. The certain consideration based on achieving certain performance parameter. Further consideration of contingent to achieve this parameter as per the transaction involved contingent consideration further since of the consideration to be settled for the variant amount of cash. This consideration would be the nature of financial liability rather than equity. As per the consideration date, the acquirer should consider acquisition date, fair value, consideration part of business combination according to such a condition would be increasing goodwill and reducing the gain and bargain purchase as maybe. Above examples, the chance of meeting performance criteria because less probable. In such case, the contingent consideration of nature of financial liability would be remeasured and the impact of the changes fair value should be recognized in state of profit and loss account. Purchase price allocation, recognition of assets and liability in acquiring entity. As acquisition date, acquirer shall recognize and are separately from goodwill and identify the asset acquired and liability assumed and by non-controlling interest of acquiring. The most important principle of the purchase price allocation is exercise is recognition measure of all the assets and liability acquired in the acquisition date. Recognition. The following condition has been considered while recognizing assets and liability of the acquiring. To qualify the consideration of the part of applying acquisition method, identify asset acquired and liability assume that met the definition of assets and liabilities in the framework of preparation presentation of financial statement in accordance with the Indian Account Standard issued by the Indian Institute of Chartered Account of India and acquired. For example, cost to acquire expect but not obligated to the future. The future of effect the plan to exit an activity of the acquiring to determine the employment of the reallocate the acquiring employees and not the liability of acquisition did. Therefore, the acquirer do not recognize this cost as part of the applying acquisition method. Instead of the acquiring recognition, these costs as opposed to combination financial statement include accordance with the NDAs 1 and NDAs. Acquiring shall only record assets and liability recovered as part of the business combination, which means only the assets and liability should be assumed as a part of the business combination deal should be recorded and only not only other assets which is not related to the acquisition to which the applicable NDA should be prepared. Whether the acquiring applies to the recognition principle under the business combination if this records certain assets and liabilities which acquiring has not recorded earlier in the financial statement. For example, acquiring an identity intangible assets such as brand name or patent and a consumer relationship that were the standard required applying of definition assets and liability even the framework of preparation financial statement according to the Indian Account Standard rather than a conceptual framework of financial framework according to the Indian Account Standard issued by 2021. Acquirer did not recognize asset in the financial statement because it is development internally and changes related to the cost of expenses. There is a certain exponential exception, certain assets and liability, which is as we discussed below. Assets and liability have been classified as per the requirement of NDAs, which have depend upon the conceptual terms and economical conditions. Certain exception specific assets and liability has been discussed below. Assets and liability has been classified as per the requirement of NDAs and it depends upon the contractual terms and economic conditions. Some condition NDAs provide different accounting depends on how the entity classifies the designation particular assets. For example, the examples of classifying the designation of the acquired shall may the basics of pertinent conditions as per the existence exit and acquisition date, including but not limited to classification of particular financial assets and liability and measure the fair value. So profit and loss on the amortization cost has been financial assets and measured in the fair value through other comprehensive income according to the NDAs 109 financial instrument and designing an derivative instrument and hedging instrument according with the NDAs 99 assessment whether the embedded derivative should be separate from the host contract and accordance with the NDAs 110 is a matter of classification as NDAs uses Only exception to the above principle is in lease contract. In this case, acquiring lease is either operating lease or financial lease, and the acquisition and the issuing contract classification will be based on the place of condition existing on the inception and not the acquisition date. Therefore, the reassess the acquisition date and unless modified by the date. Measurement principle. Assets and liability recognized based on the aforesaid recognition principle to the measurement based on the following principle. Acquirer shall measure the identifying asset acquired by the liability assumed by the acquisition date values. Each business combination acquirer shall measure the acquisition date combined non-controlling interest under the NTAs and the minority interest. The acquirer the present ownership interest and entire shareholders proportional share of entities and net asset of relevant acquisition either fair value. Present ownership instrument, proportionate share of recognized amount, and acquiring identifying interest. All other component of non-controlling interest shall be measured on the acquisition date, fair value unless other measurement basis of required 90 days. The component of non-controlling interest shall be measured on the acquisition date and fair value unless other measurement bases are required by the NDAs. Exception to recognize measurement account. The exception principle aided by the standard of recognizing measurement of certain assets and liability. Now, only limited to acquisition date accounting and may be different than the requirement of accounting standard. Applicable to the above principles may be to scenarios. Assets and liability which otherwise would not have recorded and got recorded. Assets and liability measured the value other than the acquiring data values. Items and guidance under the NDAs one other contingent liability. NDAs that is some provision contingent liability and contingent assets defined contingent liability. The possible obligation that arise from the past events whose existence will be confirmed only at the only on the occurrence or non-occurrence or one or more uncertain futures event would not would within the control of entity. Present obligation arising in the past event but not recognized because it is not probable that outflow of resources importing economic benefit will be required to be settled obligation. Amount of obligation cannot be measured without sufficient reliability. Requirement of NDA 34 does not comply with the determined method. The contingent liability is recognized as acquiring date instead of acquiring shall recognize acquisition date and contingent liability, assuming business combination if there is a present obligation that arising in past event, a fair value measurable reliable. Therefore, the quantity of NDA 37 acquire recognize contingent liability and assume the business combination acquire date even if not probable that the outflow resources importing economic benefit will be settled and settled obligation. Summary of the above outcome. NDA citizen business combination possible obligation not recognized not recognized possible obligation not probable that our outflow of economic will benefit will occur not recognized recognition if reliable measured. Present obligation probability that outflow of economic benefit occur but cannot be assured not recognized not recognized. Example 15. The suit of damages worth the 10 millions was filed in the country company B alleged to breach a certain contractual obligation. Company B disclosed some of the contingent liabilities provision statement. It is considered that is a present obligation that would not be probable that the amount be payable. Company A acquired company B determines a fair value of contingent liability and 2 million. Company A would recognize 2 million as to 2 million financial liability statement as part of acquiring accounting. Even it's not probable that payment will be required to be settled on obligation. Income taxes as per the requirement of NDA's world, not on deferred tax. The consequences would be recorded at initial recognition deferred tax, except assets and liability acquired during the business combination. Although acquirer shall recognize and measure deferred tax asset and liability arising from the assets acquiring liability assuming the business combination according to NDA's 12 and income taxes. Acquirer shall account for potential tax benefit, tax effect and temporary differences and carrying forward the acquiring that exists in the acquisition date arising as a result of acquisition and associated with the NDA's 12 benefit. Employment acquirer records a fair value of obligation and the post-retirement obligation of the principal of NDA's 119 which is expected to general fair value. The implication of the seller of the business combination may contradict indemnity, the acquirer of the outcomes of contingency and uncertainty relating to all the part of specific asset liability. For example, seller may indemnify acquirer against the losses about the specific amount of liability arising from particular contingency. In other words, seller with a guarantee that acquired liability will not exceed the specific amount. As a result of acquiring obtain an indemnity asset, acquirer shall recognize the indemnity asset at the same time recognizing the indemnity asset assured on the same basis on the indemnity form item and the same to be needed to be valuation allowance of unconnected amounts. Company A acquiring Company B, the business combination of a statement B being sued on one of the customer breach of contract of 50 crores. And the seller of B provides the indemnity and the contrary and D imposes a loss greater than 100 lakhs. There is no connectable issuance around the indemnity and the acquired company determined that the present obligation therefore the fair value of contingent liability of 50 reaches A and acquired accounting and acquiring accounting security indemnity asset for 250 minus 100 not 150. Illustration B, the ABCs acquired from beverage company and the times of acquisition BQR is undignified the code and where the certain customers of BQR has alleged that the product contains and pesticides excess of permissible level that will be contain health damages. PQR Limited is being sued for damages to crores XY Limited has indemnified ABC for the losses, if any, due to the case of amount of 1 crore. The fair value of contingent liability, the court case 70 lakhs, and how around ABC amount of contingent liability and indemnification. The fair value of the liability is 1.2 crores instead of 70 lakhs. Solution: the current scenario, ABC is measured to indemnify liability entity PQR Limited 70 lakhs and also recognize a responsible indemnity assets of 70 lakhs on the consolidated balance sheet. The net impact of goodwill from the recognition of contingent liability and associated with the indemnification asset is nil. However, the case where the liability to fair value is more than 1 crore and there is a 1.2 crores indemnity asset is limited to 1 crore only. ABC Limited pays of T crores to acquire PQR Limited and XYZ Limited. PQR Limited manufacture products containing fiberglass and main bus 10 class action concern effect of these fiberglass. XYZ Limited agrees to indemnify ABC Limited adverse of the court case up to amount of 10 crores. The class action is not specified amount of damage. Past experience suggests that the claim can up to 1 crore, but they are after settle a small amount. ABC make assessment that court case decides. Court case decides that due to the potential variance of outcomes, contingent liability cannot be measured reliable and according to no amount of recognition with respect to the court case, and that should indemnification amount be asset to be account for. Since no liability is recognized in the given case, ABC Limited will not also not recognize the indemnification asset as a part of business combination accounting. Reacquiring rights. There is an asset which is acquired before acquisition may have granted to acquire the use certain assets and belong to the acquirant. It does not matter whether the asset is recorded in the financial statement or acquired not. For example, license is used brand name. Fancy right is acquires then acquiring certain rights and granted by the acquirant in the business combination result in settlement of the right and an obligation according to the settlement gain. Law should be considered separate as an asset for the business combination. It will be recorded in the finance statement. Acquirer shall measure the value of the acquisition right as the intangible asset on the basis of remaining contractual terms of the related contract without considering effect of potential renewal. Intangible asset, the acquirer shall record separate from the intangible acquired in business combination and intangible asset is identified. The next thing is separate criteria, contractual legal obligation criteria. The refer section below the intangible asset highlighted detailed guidance of recognition and measure criteria. Share-based payment and acquirer shall measure the liability and the equity instrument related to share-based payment transaction, and acquirer replacement of acquirer share-based payment transaction, and the shareholder payment transaction of the acquirer according to the method of Ind AS 102 share-based payment acquirer date. Assets held by sale. Acquirer shall measure the acquired non-current asset. Disposal of group is classified the held or sale of acquisition date according to the Ind AS 105. Non-current asset held by sale of discontinued operation of fair value cost less to sale according to Ind AS. Lease is acquirer is a lease. Acquirer shall recognize for right of use assets and lease liability for lease identified according to Ind AS 106. Acquirer is not required to recognize the right of use of asset and lease liability for leases for which lease terms instead of 12 months on the acquisition date. Lease for which underlying asset is low value. Acquirer shall measure that lease validity present value remaining lease payment as if the acquiring lease new lease is acquired. Acquirer shall measure the right use of asset in the same amount as a lease liability, adjust to the reflect of favorable and unfavorable terms of lease and compare to market terms. Acquiring is a leisure, the measure of the acquisition detail, fair value asset. The acquisition shall take into account of the terms of lease, and acquire does not account a separate asset and liability in the terms of operating lease, and either favorable or unfavorable then compared to the market terms. Accessible workflows acquired sub-user goodwills to value of the acquiring intangible asset that is identified as an acquiring deed. For example, acquirer may attribute value of existing and as a assemble workforce. This is extending collection of employees to permit the acquirer to continue operate acquire business for the acquisition. For assembled workplace does not present intellectual capital for skilled workforce or specified knowledge and expertise in employees of acquiring brings into job. Because of the assembled workflow, it's not identifiable asset and recognized separately for goodwill and any value is attributable to substantial goodwill. Exception to recognize measurement principle limited to acquiring deed accounting asset and liability otherwise would not have recorded gates records. Recognition exception contingent liability recognized if the fair value can be measured liable. Assets and liabilities are recognized in the value other than the acquisition data value. Both recognition measurement exception income tax, employee benefit and indemnification asset leases which is acquired by leases. Recognition measurement as per NDS 1, recognition measurement NDS 19, recognition measurement acquired data fair value, measurement expectation, share-based payment asset world for sale and acquired asset, share-based payment measured by NDS 1 not 2 acquired asset held for sale measured by NDS 1 not 5 acquiring deed fair value cost less sale, reacquired asset measured the base of remaining actual terms of related contraction. Recognize ROU return of assets and lease liability as per NDS 116 except the short term lease and low value measured in the lease liability present value remaining lease payment as a new lease and recognize asset measure of ROU asset the same amount as a lease liability. Intangible assets. An explanation about the intangible asset should be recorded separately goodwill if either of the separate criteria is met arising out in contractual legal recognition. The recognition of intangible asset is a business combination transaction with definition of asset. Assets are identified other than contractual legal criteria separate criteria. Contractual legal criteria. Intangible asset is a made contractual legal criterion. Identify even the asset is not transferable and separate from the acquisition from other rights and obligations. For example, acquiring owns a separate nuclear power plant. The license of the operating the power plant is an intangible asset and made the contractual legal criteria recognition separate goodwill. Even the acquirer cannot sell or transfer the preparation from the acquired power plant. Acquirer may recognize the fair value operating license and the fair value of power plant a single asset for the financial reporting purpose and the useful life of the asset assembler. Acquiring owns a technology plant and a license of the license and patents now others their exclusive use outside domestic market. The right the specific percentage of future revenue of the foreign exchange with the market technology patent and related license agreement made by the contractual legal citation and recognition separate from goodwill. Even the selling exchange of patents and the related license agreement separate from the one other would be practical. Separatable criteria. The separatable criteria means the acquisition intangible right is capable of being separate and different from the acquiring and sold transfer license and a rated transaction exchange. These individuals together with a rated contract identifiable assets and liability. Intangible assets that is acquired would be able to sell a license otherwise exchange for something else and well of value meets separately criteria. Even the acquirer does not intend to sell license otherwise exchange the acquirer intangible assets meets a separate criteria. And there's evidence to exchange of transaction that form types of assets of similar type even though transactions infrequent regardless whether the acquirer is involved with them. Customer subscriber list are frequently licensed. This means a separate reiteration. Even the acquirer believe that customer list has characteristic difference from other customer lists. The fact the customer list is frequently licensed generally means acquire customer list means separation criteria. However, customer list acquired business combination would not meet the separation criteria in terms of confidentiality and acquire company prohibits entity selling, leasing, and otherwise exchanging information with other customer. All the intangible asset that is not individually separate from the acquiring accounting and considering entities meet a separable criterion if the separate combination with the related entity contract and identify assets and liability. For example, market participation, exchange deposit liability, related deposit relationship, intangible assets, and operable exchange transaction. Therefore, the acquirer shall recognize a deposit or relationship, intangible assets, and separate from goodwill. The acquirer owns and registered trademark and document, but unpatented technology and expertise be used to manufacture trademark product. The transfer ownership of the trademark, the owner is also required to transfer everything else necessary for the new owner to produce a product and service indistinguishable from the product produced by the former owner. Because of the unpatented technology, export must be separate from the acquiry and combined entry and sold in the related trademark sold is merely in separatable criteria. According to as per the guidance about following, identification of intangible asset will be guidable and it will vary from each case. Following possible source of information and broad integrity are used to identify any possible intangible separate from intangible resources. Financial statement of equity. The significant R&D cost may integrate that there will be any possible related technology. Significant sale promotion market cost that is a strong indication of a market related intangible for distribution networks and marketing and collaboration, etc. And customer acquisition costs. A lot of companies spend money in acquiring new customers, like online e-commerce companies provide incentive to register customer first time over download this app. This is a strong indicator of existing customer list is intangible. Share prior purchase agreement. This is also a strong indicator of existing intangible form of India technical know-how, and trademark patent which is included in the agreement. Purchase acquisition. The reason for the acquisition is ultimately possible intangible record. Coca-Cola recommend thumbs up on the intention of closing a brand, which is a result of increasing the market share. According to this, is possible of intangible asset. Company A, FMGC company acquires online e-commerce. A company E, intention start a retail business. E-commerce company has also a period of 10 million new registered users. However, the e-commerce company does not have any intention to save the customer. So the customer is recorded as an intangible of the business combination. In the solution, customer database and queues are ISO legal or contractual right. However, the assessment of separately will be assessed. The database will be useful for other players of the e-commerce as ability to transfer them. According to intention, not to transfer will not affect the assessment. The record is intangible or not. Hence, the customer list should be recorded as intangible in the business combination. The ABC is a pharmaceutical group acquired XYZ and another pharmaceutical company. Which incurred a significant research cost in connection to new drugs which has been undergoing clinical trial. Out of the two drugs, one drug has not been granted necessary regulatory approval. However, ABC Limited expected the approval will use within 2 years. Other drugs is recently received regulatory approval. The drug revenue earning potential is one of the principal reasons entity ABC is decided to acquire entity XYZ. The research and development either drugs are recognized in intangible asset of the books of ABC Limited. Solution NDA 38 intangible asset provide explicit guidance for recognizing, acquiring in process research and development. Para 21 of India 38 provides guidance for regarding general recognition condition which are required to provide the expected future economic benefit will flow and entity below one intangible asset and can be recognized for the cost of measure and reliable. As per the paragraph 33 of NDA 38, both standard general recognized criteria and probable benefit reliable measurement is always considered as satisfied for the intangible asset acquired with a business combination. Fair value of intangible asset reflects expectation and probable of the benefit. Despite of uncertainty of having amount of inflow, there is insufficient information measure the fair value of asset reliable for separator arising from the construction of a legal rights. If there is a range of possible outcomes of different probability, certain types of accounts and measuring the value of asset, the fair value. Paragraph 34 provides accordance with the standard as per NTS 103. Acquire, recognize, acquisition date separate from the goodwill, intangible asset of the acquiring, irrespective of the asset has been recognized by the acquiring before the business combination means that acquire, recognize an asset separated from the goodwill in progress of research and development project. Acquire the project meets the definition of the intangible asset. Acquire in process research and development project meets the definition of intangible asset when it meets the definition of asset and intangible. And separate arising and contraction of other legal rights. According to the above, the fair value of the first track reflects the probability of the timing of regulatory approval being obtained. As per the standard recognition criteria, the probability future economic benefit. Consider satisfaction with respect of the asset required according to the assets recognized. Subsequent expenditure of an improper in process registered Development project acquired separately until to the accordance with the para 53 to India 78 rights to second track also mean the recognized criteria of India state and recognize approval method of global future economic flow will flow of ABC which will affect the fair value of asset by the individual asset. This is a recognized process registered development of assets and acquire applies different criteria and they are required by the internal process. The research cost of internal R&D process may be under the no circumstances capitalizing intangible asset. It may be pertaining to note entities will be required to recognize as acquiring some research and development expenditure that would not have any able to recognize. It may have internal project. Although the amount attributed to the project of centered by the asset, the India 38 reflects that the subsequent expenditure incurred in the acquisition of the project of the accountant and in accordance with the para 52 to 58 of India 38. Assembled workflows and other items that is not identified. Acquirers some use that the goodwill of the good of acquire intangible asset that is not identified as an acquiring date. For example, acquirer may attribute value of existing assembly workflows. This is existing collection of employees that permitted acquiring to continue to operate in the acquiring business of the acquisition date. The assembly workflows does not assembly workforce does not represent the intellectual capital or the skilled workforce. Often specialized knowledge and expertise of the employees that will bring them job. Because of the assembly workflows, it's not an identifiable asset to the recognition separately of goodwill. Value attributable to substance and submitted goodwill. Acquire also submit the goodwill may value attributed to items that do not qualify as an asset to acquired did. For example, acquired might attribute value of a potential contract, acquired negotiation of prospective new customer and acquired date. Because of the potential contract are not themselves assets and acquired date, the acquired shall not recognize a separate goodwill. Acquirer should not subsequently classify the value of contract goodwill for the event even after the acquisition. However, the acquirer shall assess the facts and circumstances of surrounding event occurring shortly after the acquisition to determine whether the separate recognized intangible asset existing accounted. After the initial recognized acquired amount of intangible asset acquired business a combination of according to the NDAs 38 intangible asset. However, description of para 3 NDAs 38 accounting of some acquired intangible assets after the initial recognition prescribed NDAs or NDAs. Identification criteria determine whether the intangible asset recognized separately from the goodwill. However, the criteria neither provides the guidance of the provider fair value of the intangible asset or restrict the assumption until the measure of fair value of intangible asset. For example, acquire would take into account of assumption and make participation to seal the pricing of intangible asset. Acceptation of future contract renewal and pricing marketing fair value is not necessary. Renewal themselves will meet the identification of criteria. As per the business combination, acquire reacquire rights. As per the business combination, acquire may reacquire right that is previously granted to the acquiree to use one or more acquired recognition under recognized asset. For example, right is include right to use acquired trade name under the franchise agreement, right to use acquired technology, use technology license agreement, R&D acquiring a right to identify technology, and that is acquired recognition separate from the renewal. If the terms of the contract gives rise to a reacquired right to favorable and unfavorable relative to the terms of current and market transaction, the same similar items acquired shall recognize a settlement of gain or loss. Vatapao Limited, a successful company, has some number of own stores across India. Also offer franchises to other companies. Efficiency Limited is one of the franchises of Vatapao, and it is operated a number of stores in South India. Vatapao Limited decided to acquire Efficiency Limited due to the huge distribution network, according to purchase and outstanding shares on the first step. On acquiring date, Vatapao determines that license agreement reflects the current market terms. Determine the acquisition of franchise right to Vatapao at the time of acquisition. Vatapao will recover the franchise right as an intangible asset and acquired right while doing the purchase price allocation of the since it is a market term, no gain or loss will be required by the time. ABC Limited acquired PQR Limited consideration 4 years ago, and ABC Limited has granted to 10 years license on PQR Limited to operate Europe. The cost of license was 12,000. The contract allows either party to terminate the franchise at the cost of the expired initial fee plus 20%. And the date of acquisition settlement amount was 1,80,000 plus 20%. ABC Limited is acquire PQR Limited because see high potential of European market and wishes to exploit it. ABC Limited calculate the number of current economic condition and current prices. It would grant 6-year franchise to price of 4,50,000. license amount as part of business combination. The paragraph B51 of the NDAS 103 provides acquirer and acquiring may have a relationship existing before the contemplation of the business combination referred to the pre-existing relationship. The pre-existing relationship is between the acquirer and acquiring may be contractual, for example, vendor and the customer licensee and licensee, and non-contractual, for example, plaintiff and defendant. Further, the paragraph of P52 and NDAs 103 provide that if the business combination affects the settlement of pre-existing relationship, acquirer recognize gain or loss and measure the following: the pre-existing or non-contractual relationship, such as loss of the fair value; the pre-existing condition relationship, lesser or leasing; and the amount which contracts is favorable or unfavorable from the perspective of the acquirer when the compared with the terms of the market transaction for the same similar time. Unfavorable contract of it's unfavorable terms in the current market terms. It is not necessary to worry as contract in which unavoidable costs in meeting the obligation under the contract exceeding economic benefit expected review on it. The amount is unstated settlement provision, the contract available to counterparty to whom the contract is unfavorable. One and the two is less than one difference would be part of business combination accounting. The amount of gain and loss recognition depending upon the part which acquirer had previously recognized related assets or liability as reported gain or loss before. Therefore, the difference of the amount calculated by applying the above requirement based upon the instant cases license is recognized for 50,000 and the fair value of the market rate license based on the remaining contract value. The gain on loss settlement of the contract and over 3 lakhs is the amount of which the right is unfavorable to ABC compared to the market price. This is difference between the amount of ABC would receive the granting fair right for 4,50,000 compared to carrying value unamortized value granting is 1,50,000. Not like it is the amount of ABC would pay to terminate the right of the collision. So the loss of settlement is 1,90,000. Therefore, therefore the out of 1 crore paid in 98 to account is considered for the considered combination. 1 line is account for separate for settlement loss on a reacquired rights. Goodwill recognize measurement. Acquirer shall recognize goodwill as acquisition date, the measurement in excess of A and B below. Aggregate of the purchase consideration transferred from the acquired date of fair value. The amount of non-controlling interest on acquiring measured are according to the NDAs of non-controlling section, and the business combination achieved in the stages of acquiring right a fair value of the acquirer previously held equity interest on the acquiring net of the acquisition date, a method of identification asset and equity, and acquire the liability assuming the measure of accordance with the NDAs. If the business combination which is acquired and acquiring the former owner exchange of only equity interest, acquirer date and acquisition defines an identification of asset. Then the acquisition date is a fair value of acquisition equity, acquiring equity interest or be more reliable, measurable, and than the acquirable date fair value of acquired equity interest. So the acquirer shall determine the amount of goodwill use acquisition date of fair value and acquired equity interest instead of the acquisition date fair value of the equity interest transfer. Determine the amount of the goodwill in the business combination is no considered transfer. Acquirer shall use acquisition date fair value of fair value with acquired interest and of course acquiring in the place of acquisition date fair value of considering transfer. 32E bargain purchase extreme rare circumstances the acquirer may make bargain purchase in business combination in which value asset acquired in business combination exceeds the purchase consideration. Acquisition recognizes the resulting gain in the other comprehensive income on acquisition date and accumulate the same in the equity and capital reserve. It is a reason for bargaining purchase and gain and clear the excess evidence exists. It does not exist the clear evidence of the underlying reason of classifying the business combination as a bargain purchase. Then the gain shall be recognized and directly in the respect of capital reserve. Gain shall be attributable to acquirer and there will be no allocation or non-allocation of shareholder. The bargaining purchases happen. For example, the business combination that is a forced sale, which is seller acting again under the compulsion NDAs, which accomplishes that very rare bargain purchase. A business combination will arise according to the state of re-emphasis on an above point of requires entities to reassess the identify the clear reason why the bargain purchase business combination. For example, acquiring companies bankrupt, sale and sale of business due to regulatory requirement. Entity X is one of the largest liquor manufacturing companies in the world and acquired another entity which has significant presence in India and UK. However, the Competition Commission of UK has issued order to sell one division of UK asset by equity Y in order to comply with the local competition regulation UK within the specific timeline. Can entities and other laying about EQ liquor manufacturer releases the opportunity to purchase the asset of equity Y from the equity X. In the given case above, it is more likely that none that would be element of bargaining purchase the country X's other compulsion sell the assets at specific time. The mention of above recognizing gain and bargaining purchase the acquisition shall determine whether there is an exists clear evidence of understanding the reason of classifying the business combination as bargaining purchase. If such evidence exists, the acquirer shall reassess whether they correctly identified all the assets acquired and all the liability assumed and shall recognize additional assets and liability and identify the review. Acquirer shall review the procedures under the mentioned amount of NDAs acquired to be recognized acquisition data following. Identify assets and acquired assets and license to the non-controlling interest of the acquirer. The business combination achieving stages acquired previously held equity interest and acquiring and consideration transfer. Objective review ensure the manufacturer appropriately reflect consideration available information acquired. In January 2021, the A acquired 80% of the equity of B Limited in exchange of the cash of 15 crores. The former owner of B Limited was required to dispose of all the investment of B Limited by specific date. According, they do not have any sufficient time to find potential buyer. A qualifies valuation profession highest by the management of A Limited measured by identifiable net asset acquired according to the requirement of the NDAs 20 crores NDAs 20 crores and the fair value is 20% of net non-controlling interest of 4.2 crores. How should I limited recognize above bargain purchase? The amount of B Limited identifies a net worth of 20 crores exceeding the fair value of the consideration transfer plus the fair value of non-controlling interest that is 19.2 crores. Therefore, the asset in the A Limited would review the proceeding and it would use identify the measure the net asset acquired the fair value of non-controlling interest. B Limited the consideration transfer after the review A Limited decide to procure that the procure and resulting measurement of where appropriate. A Limited measures the gain on purchase of 80% or 80 lakhs and difference between the amount of identified net worth of 20 crores and the sum purchase consideration the fair value of non-controlling interest is 19.2 crores. Cash consideration 15 crores, the fair value of non-controlling 14 crores. Assuming that existing clear evidence that the underlying reason for classifying the business combination bargaining purchase the gain of bargaining purchase 80% of interest of 80 lakhs, which is recognized in the comprehensive income of the acquiring date and accumulated the same equity of capital reserve. If then acquirer choose to measure non-controlling interest of B Limited on the basis of a proportionate share of identified net asset of the acquirer, the recognition of non-controlling interest 4 crores, that is 40 to 20%, and the gain of bargain purchase 1, that would be 1 crore for 20 crores minus 14 minus 1 crore. The purchase consideration, which is consideration greater than the net asset acquired, and goodwill will reduce the purchase bargain. The net asset acquired is greater than the purchase consideration. Gain on purchase bargain. Measurement period. NDAs will not provide a measurement period window wherein all the measurement information on available in the acquisition date. Then entity will be required to do purchase by allocation basis on provision basis. During the measurement period, acquirer shall retrospectively adjust the provisional amount recognized as acquired date and reflect new information obtained about the facts and circumstances that exist on the acquisition date, and if known would have affect the management of the goods amounts recognized on the date. During the measurement period, acquirer shall recognize additional assets and liabilities if new information is obtained about the facts and circumstances that exist as the acquired date. The measurement period ends as soon as acquirer receives the information it is seeking about the facts and circumstances that exist as the proportion of acquired date will learn that more information is not obtainable. However, the measurement period does not exceed 1 year from the acquired date. The measurement period provides acquirer it's a reasonable time to obtain information. This is identify measure the following as the acquired date in accordance with the requirement of NDAs. Identify asset required. Liability assumes a non-controlling interest on the query. Consideration transfer for the query or other used measuring a goodwill. The goodwill company achieving stages in the equity interest and acquiring previously held by the query. Result of goodwill gain of bargaining purchase. As a result of goodwill gain As a result, increase and decrease in measures that occur due to the new information available due to the measurement period as it exists in acquiring date which is adjusted against goodwill. However, after measurement period ends, any change in the value of assets and liability due to information that exists in the valuation date will be accounted as a error as per the NDAC in the accounting policy change in the accounting estimation error.